Hello friends, welcome to a new video on equity derivatives certification exam of NISM. I have already prepared some videos. Now this one is where you will get to see the video on chapter 3 because I have put the video for chapter 1 already. Chapter 3 is a lengthy chapter. It runs into approximately 30 pages. So it will not be possible to cover everything in one video. However, I will try to cover some of the key aspects of forward contracts and then take you through futures contract also. But as I said, this will require more than one video. So let us start with what is a forward contract. So forward contract is a simple contract between two parties to buy or sell an asset on a specific date in future at terms decided today. So if you are preparing for exam, this becomes a very important concept for you to note, which is the definition of a forward contract. So in forward contract, as you can see here, okay, this contract is between two parties to buy or sell an underlying asset or asset at a specific date in future, which is decided today itself. Okay, and there are many underlyings for forward contracts, which could be commodities, foreign exchange, equity, interest rate. Most of the transaction in foreign exchange in forwards is what you will find in foreign exchange and in interest rates. These are the two popular ones. Okay, this and this. Equity transactions are not common in as far as forward contracts are concerned. So is commodities. Of course, in commodities you have good number of forward contracts, but still, foreign exchange and interest rate markets will top the list. Okay. Now you can see here a very simple example of forward contract where the contract is happening, okay, on 11th March. Okay. The market price on this date is 62,130. Of course, this looks a very small value compared to the price that we have. Okay. The contract happens between two parties, the goldsmith and the buyer, which is you. Okay. So here in this case, there are two possibilities. The possibility one, that there is a transaction that happens on the same day. You pay 62,130 and take delivery of the gold then and there. We'll call this as the spot transaction. But suppose you do not want delivery on 11th May 2024, but only after 1 month. Okay. Now, this is where the forward contract comes into picture because the contract is not happening uh, for transaction today. It is happening for a transaction after 1 month. Okay. Now you get a different price this time, and you agree to buy that, okay, at this price. Right now, remember the contract is happening today only, but it is for 1 month, and the price has been agreed today. Okay. So what you have done is that you have bought a forward contract, or you are going long forward. That is what it means. I hope you are getting the difference. In a spot contract, the contract happened today, the price was also for today, and transaction happened today. In a forward contract, the contract has happened today, but it is for a future date where the transaction has been agreed upon today, but actual transaction will happen once 1 month is over. But the price has already been decided. Okay. So what happens is that in case of a forward contract, okay, both parties are obliged to go through the contract irrespective of the value of the underlying asset at the time of delivery, which means you may have a price today which you have agreed upon, but when the contract actually gets completed, the price may have become different. The price agreed upon for 1 month was 62,337. It may be different after 1 month, correct? So what is the feature of a forward contract? It is a contract between two parties. All terms of contract like price, quantity, quality, of underlying delivery terms like player settlement process are fixed on the days of entering the contract. This is very important. Okay. Now, forward contracts are basically bilateral OTC transactions. They are not traded on stock exchange. This is a point to be noted. So, OTC means not traded on stock exchange. Anything which is not traded on stock exchange, by default, it becomes what we call as the OTC transaction. Even if it is traded on an electronic platform, it will still be an OTC transaction. I hope you understood this point. Okay. Now, is it possible to change the contract nature of it? Yes, if, if both parties agree to it. Okay. So, what is the reason that we have forward contract? This is an important point. The essential idea of entering into a forward is to fix the price and thereby avoid the prices. That is why we do forward contract, right? So, in exam, you may get a question: which of the following is the key reason to do a forward contract? You must know this, right? So, by entering into a forward contract, one is assured of the price at which one can buy and sell the asset, which is what has been done. Okay, and whatever is the price on the date of actual exchange of goods between the parties, the transaction will happen as the difference between the two values. Let us look at the example here to understand. Suppose after 1 month the gold price is 62,700 in the cash market, the forward becomes favorable to you because you can then purchase gold at 62,337. This is the price at which you have done the contract. So what will happen is that you will have a net profit of 363. Okay. Similarly, if spot price is 62,100, you will incur a loss of 237. So because you had done a contract at 62,337 and the price has become 62,100, the price is less by 237. Buy price minus sell price. Correct. Now, what are the limitations of forward? It has got a liquidity risk, which means it is between two parties. It is not being traded on the stock exchange. It is not listed. So, there are not many buyers and sellers, because of which you will face liquidity risk. Okay. So, because of liquidity risk, it is very difficult for the parties to exit from forward contract. That is one thing that we need to know. The counterparty risk arises because of the reason that the other party may default. Okay. So, if a party to the contract may default on obligation, if there is an incentive to default, this risk is called as default risk or the credit risk. A very important risk, because in exchange traded transaction, exchange acts as the counterparty and it takes care of this risk. Okay. Now, basically, because of these issues, these contract have to be brought to the exchange. If you bring it to the exchange, you have both liquidity benefit and counterparty risk almost getting eliminated. Now, futures contract has been created for that reason. Okay, so futures contract is basically a forward contract which is traded on the exchange. That is how we can define it. However, the definition here is that a futures contract is an agreement through an organized stock exchange to buy or sell a fixed amount of commodity or a financial asset at a future date. That's the key aspect. Okay, and clearing corporation is the entity which takes care of or which guarantees the settlement of the transaction. Okay. Uh, One thing to note here is the trader who buys the future contract is called as the long, and who sells it is called as the short. So we have long and short transactions in futures. Correct. Now, there are many instances in which assets do not change hand. Okay. Uh, so buy and sell are only because no money or underlying asset changes hand between buyer and seller when the deal is originated. Correct. So that's one thing that we need to know. Actual transaction will be settled either on a day-to-day basis, which we'll discuss later, or final settlement. What are the features of futures contract? It is a contract between two parties, centralized trading platform, price discovery, margins payable by both party, quantity decided today and quality decided today. So it becomes standardized. What is the limitation of future contract? They have limited maturity, limited underlying set, lack of flexibility, and increased administrative cost on account of MTM settlement. So you must note, if there is a question in the exam, what is the limitation of futures contract? Okay, that's very important. So this is a point that you must note. So this is a contract specification of future. Okay. The terms and conditions is what we call as the contract specification. So you can see here very clearly what is there in the contract specification. So you have instrument type, underlying asset, expiry date. Every contract expires on a particular date. Open price, high price, low price, closing price, total number of contracts traded, and the volume of transaction. Underlying value is also given, right? So futures contracts are always done on an underlying asset. Underlying instrument refer to index or stock on which the futures contract is traded. For example, you may trade an futures contract on Nifty, on a Sensex, on a particular stock. Okay. Underlying price is the spot price or price at which underlying assets trade in the cash market. There is a contract multiplier, which means futures contracts are traded in lots. Shares can be bought as one also, but here there is one lot that you have to purchase, and this is what is important for us to know. The futures contract are traded in lots. The lot size or the contract size for index and futures contract is decided by the exchange. Contract size are different for each in stocks and index. Contract size can be changed, which is very true. To arrive at the contract value, we must multiply the futures price with the contract multiplier. This is a very important concept that you should not forget. Okay. The contract size for Nifty futures contract is currently 25, which may change. So when the book was mentioned, it was 25. Now it has become 75. Okay. So you may just keep on tracking this. So there was a circular from SEBI which stipulates contract size for index futures and options. The contract stipulation is that such contracts should have value between 5 to 10 lakhs. However, this has changed. Now the focus has moved towards higher value contracts. This limit was set in 2015 since the broad market values and prices have increased around 3 times. So given SEBI has decided that this derivatives contract will not have a value of less than 15 lakhs. That is an important point that we should not forget. Correct? So lot size should be fixed in such a manner that contract value of the derivative on the day of review is within 15 and 20 lakhs. This is effective from November. There is a contract cycle, which means index futures and stocks have a 3 months long cycle. Okay, so there is a contract. If you are on 3rd October 24, you will have three contracts: the near month, the next month, and the far month. These are the three contracts that you will have. So questions could be on this also. Every contract expires on a date. Expiry date uh, is there in each contracts, and all contracts are compulsorily settled on expiry date. Okay, so you know, if you have a long position, you will have to sell the contract. Okay, and you can buy the next month's contract. Okay, now important thing to note is that Nifty and bank Nifty futures contracts and stock futures contract listed on NSE expire on last Thursday of the month, which has also undergone a change. Okay, the above example in the above example, the October-November futures contract will cease to trade on 31st October, and positions of October series will be compulsorily settled by the exchange. Now, these are all dynamic things, so you must keep on checking this. Okay, there are different index contracts. Okay, so what are the key measures that have been introduced by SEBI? Uniform expiry date across exchanges, weekly contracts. Okay, only one benchmark index option contract per monthly contracts will be also there. Okay, they will have minimum 1 month tenure. These shall expire on last Thursday or Tuesday. Change in expiry date requires SEBI approval. Okay, for example, if NSE chooses Thursday, all the monthly contracts will expire on last Thursday. NSE can only have one weekly benchmark contract every Thursday. Okay, There's a tick size. What is the tick size? It is the minimum move allowed in the price. Okay. Tick size for Nifty futures is 5 paise. So bid price is the price at which buyer is willing to pay, and ask price is the price at which the seller is willing to sell. Now this is also an important concept that we must note, because many times in exam there is a question about this. Then we have the daily settlement price, which is decided basis the purchase price and the closing price of the day. Okay. You can also buy in the morning and sell in the evening, and you will have a settlement value. Final settlement price is only on the expiry date. Okay. Which means the last Thursday or Tuesday, as the case may be. Equity futures contract basically trade from 9:15 to 3:30. Okay. The exchange publishes a what do you call as list of annual holidays, and holidays no trading is possible. Okay. BSC contracts are based on BSC Sensex. Okay. These contracts have specifications, which is underlying asset, contract size, tick size, and all that. Trading hours, expiration date, final settlement. Correct? So high correlation between movements on Sensex and Nifty enables market participants to trade in Nifty and Sensex futures as part of trading pairs strategy. The availability of weekly futures contract on Sensex and a different expiration date over Sensex future provides better trading and hedging opportunities. So I will be closing my video here itself, because we have covered too many concepts. In the next video, I will take you through important terminology related to futures contract, which could be basis, cost of carry, margin, initial margin, and all that. So please wait for that. In the next video, I will complete this chapter. Thank you so much for your time.